Global markets rally as investors weigh up the effects of the US Federal Reserve's rate cut. Pakistan's government embarks on pension reforms. It's hoping to reduce spending during an economic crisis. And we'll also explore how Nigeria's energy sector is reacting to a new refinery beginning operations. I'm Adnan Nawaz. You're watching the latest business and finance news on TRT World. Hello again. Let's start in Pakistan. The new government is facing an economic crisis. In an effort to cut spending, it's reforming the pension sector. The government has been the country's biggest employer for years, meaning hundreds and thousands of families are completely dependent on the state retirement scheme. But skyrocketing inflation means many pensioners are saying what they have now is not enough. From Islamabad, Kamran Yusuf sent us this report.
Zara Nisa's husband was a government employee. She became a widow in 2020.
I am a widow. I'm currently managing my life with the pension I receive, covering my expenses on my own. If this pension is stopped or taken away, how will I survive?
Tariq Chaudhry retired after 35 years of service in government.
The 1973 Constitution of Pakistan has outlined pension matters in detail, and there is a formal system in place for those who work in government institutions. People dedicate their youth to these institutions, but due to the new pension reforms, government employees are under stress.
The government says this unfunded pension scheme is not sustainable. It has introduced reforms to cut down its pension expenditure. Now, under the ordinary family pension scheme, family members will only be entitled to receive a pension for a maximum of 10 years after the death or ineligibility of the entitled spouse. Prior to this, entitled family members were receiving a pension throughout their lifetime. Similarly, anyone seeking early retirement will face major cuts in their pensions. This year's pension bill stands at $3.5 billion. It is Pakistan's fourth largest expenditure after interest payments, defense and development. Some call it a major economic black hole as the government funds the entire pension scheme. Authorities want to change that. They have introduced contributory pension schemes. This means new government employees will have to fund pensions. Economists believe the decision is necessary.
The bill of paying to the retired people has exceeded actually the salary bill of existing state employees. It's actually 70% more than the existing payment which needs to be made to the government servants. So government is forced to do several steps in order to bring that expenditure under control.
Pakistan is in the midst of economic crunch as it sets its eye on another International Monetary Fund bailout. One of the IMF conditions includes ending subsidies as well as reducing the pension bill. The new reforms will save up to $500 million over the course of next few years. That may not be enough, and the government may have to resort to more unpopular measures. Kamran Yusuf, TRT World, Islamabad.
Let's go to Lahore in Pakistan, and Osama Rizvi joins us from there. He's an energy and economy analyst at Primary Vision. Osama, thank you so much for your time. I think basically we need to look at how it's going to affect the people of Pakistan, but also its economy. So let's start with the people. What does this mean?
Well, to be honest, Pakistan's government at the moment finds itself what is the classic between a rock and a hard place. You see, even on a year-to-year basis, we have seen a 20% increase in the pension disbursement. Pensions currently cost around 5.6% of the current expenditure, expected to cross 50% by 2050. And in the next 8 to 10 years, essentially, the government won't have any money to give pensions. As such, the government has taken this step. I believe this is in good faith, but I do not agree with just one part of it, which is that reducing expenditure is one thing, but we also need to look at how to increase our revenue. Reducing pensions can do two things at the moment to the people. First of all, those who were the beneficiaries and the upcoming people willing to join the government might not be as much motivated. And the people who were getting pensions can face worse cost of living crisis, which has been further exacerbated by rising inflation.
Yeah, you probably hit the nail on the head there, Osama, because as you say, increasing revenue could be critical. So this figure comes from March this year. Apparently, the tax compliance gap in Pakistan is 5.8 trillion rupees. Don't worry to convert that into dollars. That's almost 7% of Pakistan's GDP. So how can the country increase tax, what's the word for it? Tax revenue.
Interestingly and unfortunately, Pakistan has reached a stage in its economic crisis where we cannot look at only one or two variables. We cannot, persuade just to correct taxes or just to increase revenue through exports. We have to look at the whole equation. We have to have a holistic, inclusive policy which will involve from everything from reducing food price inflation to generating more employment, reducing the brain drain of the country, providing more ease of doing businesses so that more companies can invest in Pakistan. Only then, when we look at it from as a whole, only then the revenue can increase, the pension systems can be made more smooth. Otherwise, bits and parts, they won't work now. We're beyond that stage at the moment.
It's that desperate. Osama Rizvi, thanks for explaining that to us. Really appreciate it.
Thank you.
A quick roundup of some of the other leading business stories from around the world. China is keeping its benchmark lending rates unchanged, despite market expectations for an adjustment following the US Federal Reserve's recent rate cut. The one-year loan prime rate, that's LPR, remains at 3.35%. The 5-year LPR stays at 3.85. Further stimulus measures are expected to support the struggling economy, while the Fed's easing, that allows Beijing to loosen monetary policy without significantly affecting the yuan. Japan's core inflation accelerated for the fourth consecutive month in August as processed food costs increased further. Consumer prices, excluding fresh food, rose 2.8% from a year earlier. That's well above the central bank's 2% target. Meanwhile, the Bank of Japan has left interest rates unchanged at 0.25%. Nike has named Elliott Hill as its new CEO. He'll begin his new job next month. Shares rose nearly 10% after the announcement. Elliott previously spent 32 years at Nike. He became president and then left the company 4 years ago. But while he was there, Nike sales grew from around $1 billion to more than $39 billion. Donald Trump says he won't sell his $2 billion stock in his social media company Truth Social. A 6-month lockup period is going to expire soon. That would allow Trump to sell the shares. The share price for Trump Media, which owns Truth Social, has fallen nearly 80% since Trump Media went public in March. Let's look at the markets across the globe. They've been responding to significant economic decisions. In Tokyo, the Nikkei has soared, driven by rising inflation. Tech stocks in the US have surged as well after that Fed interest rate cut. Tech stocks rising after the cut. Tesla leading the gains, jumping 7.4%. Nvidia climbing 4%. Lower interest rates reduce borrowing costs. That makes it more attractive for investors to buy stock. AMD shares gaining 5.7%, Broadcom 3.9%. And Japan's Nikkei 225 leading the Asia Pacific markets, gaining 2.1%. The Topix and Hong Kong's Seng advancing by more than 1%. In contrast, mainland China's CSI 300 dipping 0.2%, South Korea's Kospi climbing nearly 1%, Australia's S&P ASX 200 edging up. Back to Wall Street, the Nasdaq rising 2.5%, marking its fourth biggest rally of the year. The S&P 500 and Dow Jones both climbing more than 1%. Investors do anticipate further rate cuts, but there are concerns over the job market in the US, also that November the 5th presidential election. Very happy to say Jamil Ahmed, the chief analyst at GTC, is here, and he's usually based in Dubai, but he's visiting Istanbul, so you've been kind enough to come in. Jamil, just tell me one thing about the general picture about interest rates, because while they may have a positive effect on the economy, they can also have a negative effect on savers. So it's a delicate decision for any government.
It is, but I think it's about bringing some normality back to the global monetary environment, because you have to consider the 2020s so far, on an economic level, they've been brutal. We've had crisis after crisis, starting from the pandemic, then the crisis between Russia and Ukraine. Obviously, it was the latter that caused the largest inflation shock that many of us have seen in our lifetimes, if not a generation. And I think that now the central banks are trying to provide some confidence that they're in control of the inflation situation. and now they're trying to bring interest rates back lower. They're not going to be as low as what they were during the pandemic, but they're at least trying to provide some normality that they are going to be lower than the highest interest rate policy that some have seen in their lifetimes.
Yeah, okay, so some are cutting, some are staying the same. Brazil has been a bit of an outlier, raising its interest rate cuts. What about the Bank of Japan? What do you see there?
The Bank of Japan is in a very exciting position. Right now, they bit the bullet by keeping interest rate policy unchanged this month. I think that has something to do with the market volatility we saw in August, because we had unprecedented largest day of volatility that we had since COVID. So I think what the Bank of Japan are trying to do is they're trying to signal to the market that higher interest rate policy is coming. In fact, if the Bank of Japan do pull that trigger one or two more times, we'll have the highest interest rate policy in Japan this century. And Japan strategically has been trying to gear its economy towards higher interest rates. But what they've also tried to do is limit the market noise, because what happened with the Nikkei and the Japanese yen in recent weeks has been unprecedented. Having said that, there's still a lot of scope for a correction in the Japanese yen. We've had the dollar yen move from 160 to 140 in just a matter of weeks. I do think the scope is there for it to go towards 130. So over the final quarter of the year, we're still going to be keeping a very close eye on Japan.
Until a few years ago, China's economy was growing at that expected rate of 7 to 8%, the rate that is supposed to keep China's economy on an even keel. But it's been suffering economically in the past few years, and yet its rates are unchanged. Does that make sense?
It makes a little bit of sense, but I think that what the market wants to see and consumers is the Chinese central bank, the People's Bank of China, and the Chinese government do a bit more. I think the concerns right now is that the economic data is not convincing. We're starting to question whether the 5% GDP target for 2024 can be achieved. They would likely get over the line, but what would help get over the line with a little bit more speed and confidence is if we see more stimulus. It might be they're waiting until the final quarter, but generally speaking, we also have to take into account that the previous China of double-digit growth or going towards that 7-8%, that's not coming back anytime soon. China's in somewhat of an economic evolution as well, where it's trying to create different jobs in different sectors, artificial intelligence, more technology-based jobs, rather than manufacturing sector, which really drove the Chinese economy toward number 2. And we have to take that into account as well. But generally speaking, yes, there is scope and the need for the Chinese authorities to do more to help economic growth.
We have those numbers of the tech stocks in the United States climbing after the Fed's rate cut. When companies like Nvidia are going up and down so dramatically, almost in a 24-hour period, is that a dangerous kind of development in terms of how people are looking at what these tech companies might be worth in 12 months' time or in 24 months' time?
Yeah, we always talk about potential bubbles. The issue is that we've now been talking about bubbles in the tech sector for most of this decade.
Yeah.
What I think that's helping drive this rally is that nobody expected the Fed, the US central bank, to pull the trigger to a 50 basis point cut, which it did on Wednesday, which completely surpassed what the European Central Bank have done and the Bank of England over recent months. Because of this, and also because the tech sector has such a huge contribution towards the market value of the US stock market overall, that's why we're seeing more volatility. But generally speaking, the Fed have shown now that they're going to be aggressive. And if there are concerns that the Fed's fallen behind the curve or moving too late, they want to be in control of that situation. Historically, lower interest rates have been great for global assets and stock markets. So I think that what you're seeing in the tech sector is that they're dominant over the global market anyway. Now that the Fed has shown it's going to be aggressive and it will cut interest rates even more, that's why more money is piling into stocks once again.
Jamil, it's so great to see your face in person. I love your lapel pin as well. Thank you so much indeed for coming in. Enjoy the rest of your time in Istanbul.
Thank you.
Well, it's been a week of interest rate announcements. The US, Hong Kong, Brazil, Indonesia, all making significant moves. Turkey and the UK, though, not adjusting rates as was expected. The UK has decided to keep its interest rate at 5%. That's unchanged after it cut 50 basis points from a 16-year high. That was last month. The main reason for maintaining the current interest rate? Inflation rates have been slightly above the Bank of England's target for the past 2 months. Brazil made a slight cut of 25 basis points. The Hong Kong Central Bank also cutting its rate by 50 basis points following that American cut. Indonesia has cut 25 basis points, the only country to increase its interest rate, Brazil. The Nigerian economy has been plagued by energy insufficiency and insecurity for decades. But this week's opening of a new refinery has brought hope that things may soon improve. Production has begun at the Dangote refinery in the outskirts of Lagos. Hundreds of trucks from the state-owned oil company have begun distributing the fuel to petrol stations. But how big a break is it for long-suffering consumers? And why is the price of fuel still rising despite the increase in supply? Dolape Aderinokun reports from Lagos.
Babatunde Adeleke, a father of two, makes a living as the driver of a motorized tricycle. Is one of many Nigerians complaining about how the increase in fuel prices has affected their livelihood. Adeleke had hoped the Dangote refinery would ease the persistent petrol challenges that Nigeria has been facing, but is having doubt.
We haven't seen any benefit the Dangote refinery has done for Nigerians before it commenced distribution. Fuel price was 855 from the NNPC, while other retail filling stations were selling for over 900. I believe since the refinery started working, even with the fact it's produced in Nigeria, we own petrol, so why isn't it cheap?
I think we have to capture two key elements again. Number one is what happens to crude oil prices globally. Nigeria would have to price its crude oil accordingly, and we recognize the fact that crude oil prices are in US dollars. We have that element of exchange rate as well in it, even when they begin to sell in Naira.
You might expect the opening of the Dangote refinery to lead to cheaper petrol, as its oil is refined locally and doesn't have to be shipped in from abroad. But that's not happening. Nigeria's state-owned petroleum company, NNPC, which is the exclusive distributor of fuel from Dangote, initially set a base price equivalent to 35 US cents a litre. They recently increased it to 53 cents, and now it's gone up again to 58 cents. Joseph Bangbelu runs a school in Lagos. It's had to increase the fare that children pay for the school bus, but he says that's not a long-term solution.
Now, even though we've planned our logistics and we have been able to look at our route and plan effectively to make sure that we are able to manage our fuel resources, but at the same time, we all know that the constant changes in the economy is not going to make it sustainable for us. So definitely, it's still a planning process.
NNPC claims the estimated prices are based on negotiated terms between NNPC Limited and Dangote Refinery, considering the current international fuel prices and prevailing foreign exchange rate, in line with the provisions of the Petroleum Industry Act.
A representative from the Dangote refinery denied this, leading experts to call for more clarity from the NNPC as to how fuel prices are set.
I think that arrangement requires some level of transparency on the back of the NNPC to ensure that the entire world is aware of the status of, the details of those agreements.
Since President Bola Tinubu's administration assumed office last year, the price of fuel has increased by more than 400%. That's putting huge financial pressure on everyone in Nigeria, consumers and businesses alike. Dolapo Aderinokun, TRT World, Lagos, Nigeria.
Abimbola Agboluwaje is Managing Director at WNT Capitas Consulting and joins us from Lagos. Abimbola, thank you for your time. I want to take you back a few decades. I met the Dutchman Clemens Westerhof, the football coach who won the gold medal at the Atlanta Olympics in 1996. He said every time he was in Nigeria, one of the country's biggest oil-producing nations, the lines at the petrol stations were so long. Is it still like that?
No, it's getting better, and it's getting better because finally, Dangote refinery is selling petrol to the market. I buy fuel myself, so I can, from my experience, it's easier to buy fuel now. So it's definitely getting better, and I think it's still going to get better.
Why are fuel prices continuing to rise?
Well, that's something we need to get used to. If we're moving on to the regulated market, the prices will not be stable. And as the market adjust. People need to get, they'll need to adjust to the fact that the price will not be stable. But the government has not really helped by, giving the impression that they still control the market. The messaging has been mixed. In 2 weeks, you've had probably 4 or 6 press releases from Dangote refinery and the government basically contradicting each other. So this is leading to people getting confused about, is it a free market or is the government still dictating prices? If it's a free market, all over the world, nobody expects the price of fuel, and crude is an international commodity. You don't expect the prices to stay the same. And even in very dynamic markets, in a small town, you can have 4 different prices for petrol, depending on where people source the petrol they're selling. So far, the quality of whatever petrol they're selling is good, it's okay, it's regulated. There may be small differences in quality and small differences in prices. I think that's where we need to get to in Nigeria also.
Yeah, you mentioned the price of crude oil on the global market, but what about the collapse of the currency, the Naira? I was reading that the amount of applications from Nigeria for university places in the UK this year has fallen by almost 20% because of the collapse in the local currency. What does that do for fuel efficiency in Nigeria?
Well, many parts of the world, people buy fuel without even producing crude oil. So why should it be different in Nigeria? So the fact is that we have a forex situation that's difficult, and I think moving to free prices for petrol will be one of the things that helps us, have a stable exchange rate. And we should never forget this. The fact that we've had a highly regulated, government-dominated petroleum sector, and we've had subsidies, it's a key reason why the Naira is the way it is today. We had 8 years of straight subsidy, almost under at least 7.5 years of straight subsidies under Buhari. We're borrowing heavily in international markets at 8-9% interest rate to keep selling petrol at a subsidy. This impacted reserves negatively. So that's a history.
Absolutely, and really instructive to hear it from you. Abimbola, thank you so much for your time.
You're welcome.
Japan's elderly population has reached an all-time high, and it looks like the number is set to rise. Last year, the number of Japanese workers who are aged 65 and over increased for a 20th consecutive year to a record 9.14 million people. As birth rates decline and the population gets older, what impact is it having on the economy? Emre Bose explains.
Another 100th birthday celebration in Japan, where more and more people are living much longer lives. Recent data showed that Japan's population aged 65 and over rose to an all-time high of 36.25 million. That's the highest share of any country, and as the number increases, it's impacting Japan's labor force. Since the 1970s, the number of working people was on an upward trend, but it slowed down during the late 90s. Now, it's steady at around the high 70 million mark. Analysts expect that the labor force will decline even faster than the overall population, dropping by 24 million by 2050. This is because the birth rate is also going down. It fell to a record low last year with no sign of picking up. If it continues to fall, it will slow economic growth, reduce government revenues, and lead to lower labor force participation. Japan's economic growth has already been struggling since the beginning of 2023, hitting negative growth for 2 different periods. Today, certain industries are in danger due to lack of workers. Take, for instance, the agriculture sector. It accounts for about 1% of Japan's economy, and almost 70% of its 1.4 million farmers are 65 and above. The government has moved to increase the number of foreign workers in the country as a solution to the labor shortage. accepting more than 800,000 skilled workers by 2028. But as the population continues to grow old and the birth rates decline, the economic effects of an aging population will be felt throughout the economy. Emre Boz, TRT World.
Romania's energy and grain sectors are undergoing significant change. With declines in grain exports, a push for renewable energy and major investments in energy infrastructure, Romania is navigating a complex path to secure its economic future.
Grain exports from Romania's Constanța port fell by 9.1% in the first 8 months of 2024 compared to the same period last year. A total of 20.18 million tons of grain were exported, with reduced Ukrainian grain deliveries impacting overall flow. Constanța remains a crucial corridor for Ukrainian grain exports and fuel imports despite the decline. Romania aims to increase power plant capacity to over 32,000 megawatts by 2030, with 75% coming from renewable sources. The government rejected the EU's 41% recommendation, targeting 38.3% instead due to perceived feasibility concerns. Solar, wind installations, and nuclear energy will contribute to reaching this goal. Meanwhile, a private company, Electrica, is building a 70 megawatt-hour storage facility in Mureș County, investing $24 million to stabilize the energy system. The project is partially funded through the Resilience Facility, addressing critical energy imbalances in Romania. In a significant development, the Nava Salame family acquired the Octagon gas and logistics terminal in Constanța to strengthen Romania's energy security. This strategic move supports stable LPG supply and boosts Romania's resilience against market disruptions. The acquisition aligns with Romania's push for a more diversified and secure energy infrastructure.
The Chinese government says it's soon going to start importing live seafood from Japan again after imposing a ban in August last year because of the Fukushima nuclear disaster. China is the biggest importer of Japanese seafood in the world. You're up to date. Time for the Newsmakers.